So we'll start with reading number 49 of the CFA Level 1 curriculum that will give us a detailed overview of the various types of equity securities. So when we generally say equity security or an equity shareholding, we are referring to the common shareholders. So common shareholders have a residual claim on the firm's assets and they govern the corporation, that is, they are the owners of their company who govern their corporation through their voting rights. So a residual claim implies that after claims of the other stakeholders, that is debt, preferred equity, employees, any litigation, etc., has all been paid off, whatever is remaining belongs to the common shareholders. Common shareholders are entitled to receive dividends. These dividends, however, are dependent on the profits that the company makes and hence can be variable in nature. The firm has no legal obligation to pay dividends. However, as we'll see in the review on valuation, dividend paying firms generally will be valued highly and would be preferred by investors. So companies do tend to pay dividends under many circumstances, and shareholders receive dividends as cash inflows from the equity securities that they own. So equity essentially implies ownership in the form of common shareholding, which has a claim to the residual assets of the firm. So common shareholders vote for the board of directors. Board of directors represent the shareholders' interests to the management. So the board of the directors are the link between the shareholders and the management. So the management is generally referred to as an agent of the principal or of the shareholder. So the management of a company works for the shareholders in the interests of the shareholders, and they get salary and performance linked bonuses, etc. The board of directors represent the shareholders' interests to the management, that is the CEO and the other top staff. So the shareholders elect the board of directors, and it's a process of voting. Proxy voting is generally allowed, that is, if a shareholder is not present physically himself, then a representative or through some other manner the voting can be done. Now in a statutory voting system, each share equals to one vote for election of each member of board of directors. So if you have 100 shares, that means you have 100 votes. So each share equals one vote. However, the problem in a statutory voting system is that you can vote for only one person. So if there are 5 board members, and let's assume there are 10 candidates, then even though I own 80% of the company, I can influence only 1 out of the 5 board seats. That is, each of my shares is entitled to be one vote. However, I can vote for only one person. So even though I own 80% of the company, I can influence only 20% of the board seats. The remaining 5 will be chosen by the other shareholders. In a cumulating voting system, on the other hand, it's the same. Each share equals one vote. However, the shareholders can allocate their shares to one or more candidates. That is, if I have 80% shares, or I have 80 shares out of a total of 100 shares, then that 80 I can give 10 to one candidate, 20 to another candidate, 40 to another candidate. That is, my influence on the board can be much higher than in a statutory voting system. So this is the most common class of equity that is generally issued by corporations across the world. So callable common shares are like common shares in that they have the same voting rights and they're also entitled to the variable dividends. However, the downside of callable common shares is that the firm can call these shares back from the investor Or in other words, the firm can repurchase these shares from the investor or the shareholder at a pre-decided price. So let's say the firm issued a callable common share for $50. However, the share is callable at a price of $100. So in such a case, for all practical purposes, the upside of these shareholders is limited to $100 because if the stock price goes above $100, then the firm has the right to buy these shares back from the shareholder at $100 and pay him $100. So the upside, remember, of callable common shares is limited, hence they are not as lucrative or as preferred as regular common shares. The reverse is the case with puttable common shares. So in callable common shares, the right is with the firm. In puttable common shares, the right is with the investor. So in this case, the investor or the shareholder can sell the shares back to the firm at a pre-decided price. So let's assume the shares were issued at $100 and let's assume that they are puttable at $50. So in such a case, the downside of the investor is now limited because he purchased at 100, the upside is all his. However, on the downside, if the share goes below $50, the shareholder can still sell it back to the company for $50. Hence, puttable common shares are more valuable than regular common shares. They give an additional right to the investor or to the shareholder. Callable common shares give an additional right to the firm and hence are less preferred to regular common shares. Another type of equity is referred to as preferred equity or preferred stock. So preferred stock typically does not mature. So it's like debt in many ways, or it's like a fixed income security in many ways. However, it does not have a maturity date like a regular fixed income security. So if $100 preferred stock is been issued with a 10% preferred dividend, then this $10 will continue, or the firm will generally pay the $10. However, there is no pre-decided date at which this $100 will be redeemed or at which the preferred stock will be extinguished. So this $10 will continue for the life that the preferred stock is outstanding. There is no date at which the $100 principal will be returned. So the interest or the dividend will be continuously paid. Preferred stockholders generally do not have voting rights, and the dividends are fixed in amount but are not a contractual obligation of the firm. So in case the profits are not enough, then first the debt holders will be paid, and only if money is remaining, any funds or money to preferred stockholders will be paid. So preferred stockholders will be paid before common shareholders or before common equity, but after fixed income instruments or after paying debt if any money is remaining. Cumulative preferred shares require that any dividends that were missed in the past should be paid before common shareholder received any dividends. So let's assume I missed this $10 payment in 1 year. So if I miss it, then in case of a cumulative preferred share, in the next year I'll have to pay 10 plus 10, $20 before any payout can be made to the common shareholders. In non-cumulative preferred shares, if a payment gets missed because the profits were not sufficient, then the payment gets missed. There is no obligation of paying double the amount next year or any such thing. Participating preferred shares receive extra dividends if the firm profits exceed a pre-specified level and a value greater than the par value if the firm is liquidated. So they participate in the profits in some manner. They're still not like common shareholders who get all residual value, but they participate in the profits to some extent is what you can assume. Convertible preferred stock, as we'll see in more detail in financial reporting, can be converted to common stock at a pre-specified conversion ratio. So we'll do a couple of examples of this in financial reporting. If you've already done that class, then you would have seen a few examples of convertible preferred stock. So these can be converted to common stock. Some companies' equity shares are divided into different classes. That is, a class A and class B common shares. So different classes of common equity generally tend to have different voting rights. So a class A may not be allowed to vote, whereas class B is allowed to vote for the board of directors, or class A is not allowed to vote for significant M&A transactions, something like that. So there is some difference in voting rights and some difference in the priority in liquidation between class A and class B shares. Hence the value at which the two will be trading will also be different corresponding to these rights. Compared to publicly traded equity, private equity firms have lower reporting costs because they are not listed on an exchange, so they don't have to comply with all the rules and regulations that the regulators impose on publicly listed companies. They have a greater ability to focus on the long-term prospects and potentially greater return once the firm goes public. So if you invest in a private company, your risk will be higher because the reporting and the governance will not be as strong as a public company. However, the long-term prospects and the returns can be better because they are not judged on a day in day out basis by investors and analysts, etc. So they can focus more on the long term as compared to public traded equity or public firms. However, private equity investments do tend to be illiquid. The financial disclosures may be limited and the corporate governance may be weaker as compared to publicly listed firms. Now the returns from equity investments come from dividends, that is the cash outflows or the residual income that is paid to the shareholders. It could be capital gains, that is stock price appreciation, or it could be losses from a decline in share price. Any foreign exchange gains or losses if you've invested in the shares of a foreign company, and the compounding of reinvested dividends, that is the earnings that are not paid out to shareholders, rather they are reinvested into the firm, has traditionally been an important part of an equity investor's long-term return and the long-term capital appreciation. So stock prices go up because firms reinvest the funds that they have earned and generate further return on those reinvested funds, resulting in higher value for the company and for the shareholders. Preferred stock is less risky, as we studied, because preferred stock pays a known fixed dividend. These stockholders must receive dividends before common stock dividends are paid. So preferred stocks have a claim equal to the par value if the firm is liquidated. So in the case of bankruptcy or any form of liquidation of the firm, the par value of preferred stock will have to be returned first before any payout can be made to equity shareholders. Puttable shares are least risky and callable shares are most risky, as we discussed. Cumulative preferred shares are less risky than non-cumulative preferred shares, as any dividends missed must be paid before a common stock dividend can be paid. This also we discussed. Now we will refer to a market as integrated if capital flows freely. That is, we can buy and sell any security or any asset in that country, take our money out into another country. And so if funds can easily move into the market and funds can easily move out of that market into another market or another country, then we will call the market as integrated. So in integrated market, it's normally not a problem. You can easily invest and repatriate your returns or cash in your investment whenever you like. In markets that are not fully integrated, it becomes a little difficult. So you have to find out ways and means of acquiring a stake in companies listed in these non-integrated markets. So with special regulations, many a times direct investing is allowed. So direct investing means going into that country and buying the assets. So buying foreign securities in foreign markets would be an example of direct investing. Depository receipts are another way of taking a stake in a foreign market. However, through depository receipts, what the foreign company does is that the foreign company gets listed on the local exchange. So a depository receipt represents ownership of foreign firms but are traded in the local currency. So if I am an India-based company, for instance, and I feel that there will be a lot of investor interest in my company in the US, then I can go and get my stock listed on the US exchange. Of course, I will have to comply with all the US regulations and disclosures. But what this enables is that the US investor doesn't have to go to India to buy my share. He can simply purchase the American Depository Receipt, also referred to as ADR, and get a ownership in my company. GDRs refer to Global Depository Receipts. So this is when companies are listed in other countries except the US. So if a Mexico-based company or a Morocco-based company lists in the US, then that will be referred to an American Depository Receipt. If that company lists So if an Indian firm lists in Great Britain, for instance, then the securities can be purchased in pounds directly from the London Stock Exchange. So those securities will be referred to as GDRs, or Global Depository Receipts. So G stands for global. If it lists it in any other country, in Spain, in France, in Germany, then it will be a Global Depository Receipt. Only for US there's a special name, or we call it American Depository Receipt. So it's the shares of a foreign company, however they are listed on your local exchange. So a US investor can buy them in US dollars, a British investor can buy them in pounds, so on and so forth. Investors who buy foreign stock directly on foreign stock exchange receive a return denominated in the foreign currency. They must abide by the foreign stock exchange's regulations and procedures, and may at times be faced with less liquidity and less transparency than is available in their home markets or domestic markets. So if a US investor buys in India, then first of all the Indian currency movement affects him, then Indian regulations and procedures is what he has to comply with. There may be less transparency as compared to the companies listed in the US that have much stringent regulations. So to avoid these disadvantages, investors would prefer purchasing depository receipts of the foreign stock that trade on their domestic exchange. So GDRs, or Global Depository Receipts, are issued outside the United States and outside the issuer's home country. American Depository Receipts are denominated in US dollars and are traded on US exchanges. So they are just a special name for US listed securities of foreign companies. And another term called global registered shares are again common shares of a firm that trade in different currencies on stock exchanges throughout the world. So these are globally registered shares. So these shares can trade in multiple exchanges in the world. So for American Depository Receipts, there are generally 3 levels. So if it's an OTC registration, so please note, if I am an Indian company, then for me to get an ADR registered, or for me to be listed in the US, it's going to be expensive. I will have to follow all their norms. I will have to follow accounting by the US standards. I will have to meet their regulations, so on and so forth. So, for level 1 listing, the costs are normally not very high. However, you will not be allowed to access the exchanges in the US. So, your shares can only be traded over the counter. You will require a registration, but you will not be able to raise fresh capital in the United States, and your compliance costs, listing expenses, etc., are generally low. So if you just want a presence in the US, you don't really need money, you don't really need new capital, etc., then a level 1 listing is what an Indian company or a foreign company can go for. A level 2 listed ADR will be traded like any other US stock. So if an Indian company gets listed in the level 2 route, then it will be traded on the NYSE, Nasdaq, and the Amex. Registration will be required. You still can't raise capital in the United States, and listing expenses and compliance costs will be high. For a level 3 ADR, again, basically regulations will be even more stringent, and this kind of a company can even directly raise new capital from US investors directly from the US. Rule 144A applies to private companies, so no registration is required, and you can raise capital, but again, you can't go to retail investors. You can only go to qualified institutional investors, etc. So this is also a common route for companies listed abroad to raise money in the US. Now, very importantly, the book value of common equity is defined as the difference between the financial statement value, very important. So it is just the reported value of the firm's assets minus the reported value of the firm's liabilities. Positive retained earnings will increase the book value of equity, and negative retained earnings or losses will decrease the book value of equity. So book values today reflect the firm's past operating and financing choices. So a firm has assets, that will be his plant and machinery, some cash on books, some accounts receivable, and it will have some liabilities. There will be long-term liabilities like debt that has to be paid. There will be some current liabilities. So whatever is remaining of the assets after paying off these liabilities is referred to as equity or book value. So book value is the reported, but please note that balance sheet items are at historical cost. So plant and machinery, cash, accounts receivables will all be at historical cost, and so will the liabilities. The difference between the assets and the liabilities gives you the common shareholding or common equity, also referred to as the book value of equity. Now, the book value of equity will often differ from the market value of equity, which is simply the share price multiplied by the number of shares outstanding. So while book value is a accumulation of past activities and past financing choices, so depending on how much debt you have chosen to keep, depending on what assets you have purchased, will define your current book value of equity. The market value, on the other hand, reflects expectations about future cash flows and future accretion to this book. So the market value of equity can also be written or can also be thought of as the perceived fair value of equity. Well, this is how the market perceives the fair value of the book to be, or the fair value of the equity to be. So even though assets minus liabilities is so much, since the balance sheet represents historical values, the current value of the equity may be different from the book value. So the market value is the fair value of the book, or the fair value of the equity, or this is the price that needs to be paid to acquire the company today or to buy out the company today. The market value reflects investors' expectations about the timing, amount, and risk of the firm's future cash flows. So book value of equity is defined as the firm's assets minus the firm's liability. Market value is the outstanding number of shares multiplied by the stock price. It reflects expectations about future performance. Sometimes market value can be less than book value also. If expectation is that future performance will be very bad and the company's assets will reduce in value and liabilities will go up in value, the market value can even be lower than the book value. If the expectation is that the company's assets will grow and the company's liabilities will reduce, then the market value will be higher than the current book value. The market value and book value are seldom equal. They're normally very different. A very important metric that every investor or every shareholder is very interested in is referred to as the return on equity, or the ROE. So the return on equity is defined as the net income upon the average book value. Now, why this calculation is very important is because as a common equity holder, net income is what he receives, or net income is actually the income of the common shareholder. After paying off debt, that is after paying off interest expense, after paying off employees, raw materials, etc., this is the amount that is remaining for shareholders. But how much have shareholders invested in the business? Or what is the shareholders' claim on the business? It is the book value, because the assets after paying all the liabilities belongs to whom? Belongs to the common shareholders. So this is the investment that the shareholders have in this company. And on this investment, the net income is the return that they are getting every year. So an investor, when deciding whether he should keep his money in the stock or keep his money invested in this company, or at what valuation he should invest the money in this company, would always be interested in evaluating the return on equity. That is, what is the income that the firm is generating on the investment that has been made by equity shareholders. Because today the firm can sell its assets, sell its liabilities, and return this equity back. However, if the firm is keeping it invested, then there should be a commensurate net income also that should be produced. So the ROE is calculated as the net income divided by the average book value. And a lot of times the ROE is calculated as the net income divided by the beginning of year book value. So both methods are correct, both conventions are used. Just make sure that when you're comparing, if you're using the beginning book value for one company, use the beginning book value for the other company also. So net income upon the beginning book value, or net income upon the average book value, is the return on equity. Average simply means the beginning value of the book value and the current value of the book value divided by 2. So we'll do an example and understand this. Given the figures below for share industries, calculate the return on average equity for 2005 and the total market value of equity, the book value per share, and the price to book ratio at the end of 2005. So the first calculation is the return on average equity. So return on average equity will be calculated as the net income upon the average book value. So the net income in 2005 is given to be 3645 divided by the average book value. So the average book value is the total stockholders equity. So this will be 19402, that is the current book value, plus 16141, that is the book value at the beginning of the period, divided by 2. So this will be the return on adjusted equity. The market value of equity would be the stock price multiplied by the number of shares outstanding. So this will give us the market value of equity. The book value per share at the end of 2005 will simply be the total stockholders equity divided by the total number of shares. So it will be 19402 divided by 3895. This will be the book value per share. And the price to book ratio at the end of 2005 can be calculated as the price per share divided by the book value per share. So we have the price per share, that is 17.1, divided by the book value per share, that will come from the calculation that we just did. So this is how we can calculate the metrics that we need. So please verify. The return on average equity will come out to be 20.51%. The market value will come out to be 66604. Book value per share would be about $5. And the price to book ratio would be 17.1 divided by 5, that is approximately 3.433. Now please note that we'll study the price to book ratio in more detail when we study ratio analysis and when we study equity valuation. But it would be important to understand that the price to book ratio essentially tells us how different is the market value of equity from the book value of equity. So if the price to book ratio is 3.433, for instance, then what this implies is that the current market price is 3.4 times, or market is willing to give 3.4 times the reported book value of equity. So the market is expecting future cash flows and future profits to be good, such that assets will go up, cash will go up, and equity will go up in the future. In a company where expectations are good, the market price will be much higher than the book value, or this multiple will be high. In companies where expectations are poor, the market value of equity will be lower, or this multiple will be lower. Now, the book value of equity essentially goes up to the extent of the retained earnings. So what is book value? It is the equity. If in a particular year I have a net income and I pay it all out as dividends, then my book value of equity won't change. To the extent that I retain the earnings, the book value will keep going up. So if the market is expecting that high income will be earned and it will be reinvested in the business. So if I reinvest in the business, I can buy more assets. I can generate more income in the future. Then the market will be willing to pay a high price to book ratio. or the market price per share, which in this case is 17.1, will be much higher than the book value per share. So price to book multiple is also an important valuation metric that we will see in the sessions to come. So the accounting return on equity is calculated as the firm's net income divided by the book value of common equity, as we just did in the example. ROE measures whether the management is generating a return on common equity, but is affected by the firm's accounting methods. So the net income, depending on the depreciation policies, depending on various accounting policies, will be impacted. So even the ROE can be impacted by the accounting methods and may differ from firm to firm depending on the accounting method. The firm's cost of equity is the minimum rate of return that investors in the firm's equity require. So investors' required rates of return are reflected in the market price of the firm's share. So the ROE should ideally be higher than the cost of equity. So the return that the net income that the company is generating depending on the equity should ideally be higher than the cost of equity. If that is the case, then the firm will be valued highly, or the price to book multiple will be high. If the ROE is much higher than the minimum required return, then the price to book multiple will be even higher. If the ROE is much lower than the cost of equity, then the price to book multiple or the market price will not be very high. So that was about the reading number 49 that gave us an overview of equity securities. Thanks a lot, and we'll continue the discussion on equity in the coming sessions.